All right, it's time for hot picks, and we are looking for them in the small cap space, which have perked up a little bit in 2023. And our next guest says there's significant opportunity to look for unprofitable small cap companies, but that will become profitable, similar to the dynamics that we saw during the tech bubble and the early 2000s. For more on this perspective, we've got David Barr, CEO and Portfolio Manager at Pender. David, so nice to see you and speak with you once again. And I love how you're starting, because so many people will just be tempted to throw out all unprofitable companies. And you brought along this great chart that looks at the profit journey of a company relative to the performance. Can you just walk us through that?
Yeah, good morning, Amber. It's what the chart shows. It's looking at the dot-com bubble, so 2000 to the 2004 time period. And yeah, as we know, there was just some speculative mayhem in the tech space back in 2000. And the performance of companies coming out of that. So obviously the profitable companies, the drawdown, the price correction was less dramatic than the unprofitable companies. Unprofitable companies had a very significant price correction. Those that remained unprofitable, never really recovered. And a lot of those businesses are the ones we make fun of today, because they went bankrupt coming out of the dot-com time. But those businesses that actually had the unit economics, the great business, had revenue and drove towards profitability, those were the ones where you found the really big returns coming out of the dot-com boom and then subsequent crash. So
with that in mind, that's kind of a clear theme, it looks like, that you're focused on. Let's get to your first hot pick. This is Copperleaf, software company. What do you like about it? What kind of upside do you see?
So Copperleaf's a company we've followed for over a decade. It's had double-digit top-line revenue growth, and along the theme of a lot of these other tech companies, it IPO'd in 2021. Ran up, got a big valuation, and last year came back to earth. And when we look at the company, you look at the income statement today, and headline, it's losing a lot of money. But you go back, you read the prospectus when they did the IPO, and you can see the operating cash flow was actually positive leading into the IPO process. So here's a company, they sell to big utilities. It's a long sales cycle. They've never lost a customer. So when you can add revenue and you're never losing a customer, you can spend a lot of money trying to attain those customers and make it really efficient for your long-term value to customer acquisition costs. So we just think it's very well positioned. Utilities have to invest in their infrastructure right now, particularly with ESG tailwinds. So we think this has a long runway.
WeCommerce is an interesting play because it's found a business within the Shopify ecosystem.
Yeah, so it's a great platform of selling services and products into Shopify merchants. Obviously, we've seen the slowdown and the big correction in Shopify. So WeCommerce ran into a bit of trouble. It was being focused on that market segment only. They obviously had some headwinds. The company had taken on quite a bit of debt to consolidate the space. They've announced an acquisition or a merger with Tiny Capital, which is the parent company, and it's a wonderful transaction for the business. It diversifies their revenue stream into 3 different segments: their Beam segment, their Dribble segment, as well as WeCommerce. And then it cleans up the balance sheet, taking their debt from over 3 times debt to EBITDA down to about a very manageable 1.5 times, and bringing on board Chris Sparling and Andrew Wilkinson, the co-CEOs, who have driven the growth of Tiny since inception. So great capital allocators, great operators, diversified business, strong cash flow.
Thinkific is your last pick, another stock chart that looks pretty ugly over the past year. But what do you like about it going forward?
Yeah, so I mean, here's a company that's almost trading at the value of the cash on the balance sheet. Something was pretty consistent with what we saw coming out of 2000. The company itself has a platform for creators to monetize their course content online. They've been able to grow at double digits since inception. And again, here's a company that's raised a lot of money on their IPO. Stock went crazy. They aggressively spent on sales and marketing and R&D. They've had 2 dramatic headcount reductions to get their cost structure in line. And again, if you look at this company pre-public, they were very capital efficient. The founders basically bootstrapped this business with very minimal capital. So inherently, this is a profitable business. It's going to grow into that. And hopefully we'll experience that stock chart we led off with.
All right, David, thanks so much for joining us with these ideas. We appreciate it. That's David Barr, CEO and Portfolio Manager at Pender.